Yeah, I got a question, Chris. So we were looking into, we just established our LLC, and a lot of the information that we read is kind of that Delaware C Corp thing. Initially that was really what everyone did, and it was kind of weird if you didn't. And some of the guidance that we've seen more recently was that a lot of it has balanced out. And so for it actually to be Delaware, it's not as big of a deal anymore.
Mhm.
Are you dealing more with like, I don't notice this, like the older folk that want to see the Delaware, or is it kind of cool now to be, other states that have similar regulations?
Um, that's the key word, is the similar regulations. Colorado actually copied a lot of Delaware, and I actually think a Colorado C Corp is nearly as good as a Delaware. Um, the the issue becomes there's something called case law, right? The state of Delaware has had so many corporations for so many decades that almost everything has been challenged in court. And because of that, there's a whole lot of case law precedent that says this is what will happen when you do this. That's the reason people liked Delaware. But structurally and tax reasons and lots of other things, there are several states that are nearly as good. Colorado being one of them, right? Utah is another that people like for some reason. You may be forced to change if you went out and raised $10 million from a VC fund, right? And the reason is because they've got a process and a template in place. That's all.
Excellent. Thank you.
So,
That makes a lot more
yeah.
sense. And while I have the floor, I just got one more question on it. Back in some of your pro forma, you obviously went all the way back to 2017 and you broke it up by quarter. And I might have missed this. Are you going back and putting the actual numbers in that when you pass that time? So you're making it actually real? You're going back and putting the real information in there, correct?
Yes.
Okay.
So I like to do that. The reason is that you can show an investor, here's real data and here's where it breaks away, right?
Mhm.
Most startups don't have past performance, right? They haven't been in business for 2 years or selling for 2 years or whatever. So not everybody's got that data, but if you do, it's it shows reality, right? If you burned $1 million and have nothing to show for it, maybe don't show that year. But at some point they're going to ask you about it.
Yeah, lost all the documentation for that year, but
Yeah, exactly.
Cool. Thanks,
So,
Chris. Appreciate that.
Yep.
Hey, Chris, I'll shoot. Quick question as far as valuation goes. You talked about the different rounds. How would you go about assessing or coming up with a valuation within each round? Like going to friends and family, do I just ask for a loan or do I try to give them some shares?
So during a friends and family round, and maybe even some of the early angel rounds, the easiest cheat is to use a convertible debt or a safe note. That's kind of been the policy for a long time now. The reason is because then you don't have to come up with a valuation. What it really says is you're going to give me, $100,000. While I'm sitting on that money or using it, it'll accrue 8% interest. And along the way, in 3 years, I owe you that money back plus interest, right? Which has got a balloon note, so you're not paying along the way. And if we go raise money between now and then, say in a year I go raise $5 million from professional investors, this is what will happen, right? It's got triggers, is what they're called. And generally there are a couple of things. One, there's a minimum round size, right? So it says if I raise $1 million or more or $2 million or more dollars, then a stock conversion happens. And then it basically says you will convert at the pricing of that next round, but you'll get a discount. And so the discount rate generally is 20%, is what most people put into the documentation. And so that means that if the new professional investor is investing $1 to buy 1 share, the person who invested, who loaned you money long ago only has to pay 80 cents per share. So when you combine that 20% discount on the price, plus the interest they've earned over the time, which adds into the base, right? They're getting, more than a 20% discount effectively on it. And the reason that you're giving them a little bump is because they put money out there first, right, and took more risk. So that is really the common thing. And then some of the angel groups out there now are pushing people to do priced rounds, is the term they'll use, as opposed to doing convertible debt. It's I'm trying to think. Rocky's Venture Club is one in Colorado. They almost always force you to do a priced round, and they almost always force you to evaluation. So it is what it is. You can argue it by going out and getting, statistical data on your industry. We used to use multiple of EBITDA as the startup metric of choice, right? And it'd be depending on the industry, right? Something with recurring revenue, something that's software, will have a very high multiple, and other industries might have lower ones. Now I'm seeing a lot of rounds priced at a multiple of top line revenue, usually because they're not profitable yet. And there's some ridiculous ones, but I did just see one of our local companies raise 25 million at a 20 times top line revenue valuation. That's really high. The reason was because they have a very high growth rate, right? So when you're just like if you were buying, Apple stock, you're paying more than the regular price to earnings ratio average because you're expecting the stock to grow a lot and revenue to grow over time. And so there's formulas for that, but it's nearly unique for every company, unfortunately. You can make all kinds of arguments, but the investors may say it's worth $3 million. That's it. And it is what it is, right? And there's, like I said, there's a whole nother presentation on this thing, but pre-money valuation and post-money valuation are different terms you'll see a lot. There's a book, it's on the other side of the room, called Venture Deals by one of our local guys, Brad Felds, that's explains a lot of those terms. And it's good to read that before you walk into a room with a professional investor. It'll just make you able to understand the language better. I'm trying to think of what else is important. I don't know. A lot goes into valuation, right? But like I said, there's usually standards, and it's just like buying and selling a home. There's comps, right? Here's another company that's in a similar area, also selling software, also in this market, right? And they just raised money at this valuation. And you can find some of that data on places like Crunchbase, which is a good source for information. And like I said, you can try and argue it, but often the investors will push you around. So, only other thing, what usually happens is the first investor that you actually sign with is the one that'll force the valuation, right? So usually people will be so excited. I'm raising $1.5 million, and these guys want to come in with $750K. They want to take half the round, and essentially you're so ecstatic that you sign up for whatever they want. Just remember that every other investor is going to get the exact same pricing and terms for that round. So if you are taking that money, remember they're setting the precedent.
Yeah, and Chris, on the same note, for convertible notes, when you guys think about those early on, be really careful with your terms, because the next round will want the same terms. So if you're being really nice to your family with terms, 3 times or whatever it may be, different triggers and stuff, they'll want the same deal. And so dilution can be a real problem if you're not stringent on that first group of monies you take.
Mm-hmm.
And Venture Deals, by the way, they do have like a little online course that you can take that goes through a lot of this stuff. It's free. you know, it was worth the exercise of going through all the math, because it's a lot of math. I mean, you know, I think Chris, you've covered a lot of it, but to actually do it on paper is it's a little more daunting, I think, than it sounds.
True.
Awesome.
else?
Any more questions for Chris? Yeah. Speak now or forever hold your questions. All right, Chris, I think that's it. Thank you so much for doing this.
Sorry,
webinar.
I actually do have one quick question.
Oh, okay. Go ahead.
Sorry, my apologies. I couldn't find the screen. Will you make the pro forma chart available to us by chance, or can you make a general one for us to potentially reference?
Prakar's got the charts in PDF form. I don't have what I would consider a penultimate template, because it changes by every company. You know, but if you generate one or you want help with it, right? Obviously, Leaf knows all this stuff too. Prakar probably does. You're welcome to ask me to take a look at it and review it. You know, I'll suggest things that might be missing, or if it looks believable or not. There are tons of templates out there on the internet. I actually think it's better to build your own, only because you get, you know, then you know how everything works. So you're more in control of it.
That makes a lot of sense. All right. Thank you very much. Appreciate it.
Yep.
Awesome. Thanks, Chris. And yeah, I'll upload all the slides on Notion, week's 7 resources. And again, thank you so much, Chris, for coming on and doing this webinar with us. Really, really appreciate you speaking, and have a good afternoon, everyone.
Yep. Thanks, everybody. See ya.
Thank you.
Thanks, Chris. Appreciate it.
Bye.